Hi, how are you guys? I hope you'll be good and safe and sound wherever you are. And today's video, we are gonna start the accounting ratios, which is very important for every student who is adhered to the field of accounting and finance, because the student are the professional who are working in the field and finance department or in accounting department. They are all need financial ratios, accounting ratios. Okay, so accounting ratios are divided into four categories. Number first, performance ratios are profitability ratios, as it is written here. You can see in the title. I gonna highlight it. Okay, and coming down, scrolling down the mouse, you can see the gross profit ratio. This is the gross profit ratio. Okay, and the second is net profit ratio. These are all performance ratios, are profitability ratios. Today and today's lecture, we are gonna complete the performance ratios only: return on capital employed and return on assets. So these are all, and after completing after the completion of performance ratios, and the next video we will discuss with detail liquidity or short-term solvency ratios. Okay, so let's start. What is gross profit ratio? When a company prepares financial statements, uh, and every country have their own rules and regulation in the Companies Act, uh, which explains the format of the financial statement. Financial statement will give true and fair view. True and fair view. When it will give true and fair view, when it is prepared in accordance with the applicable framework IFRS. In Pakistan, International Financial Reporting Standard, IFRS is applicable framework, IFRS. All right, and every country has their own applicable framework. Like American applicable framework is GAP. They're using GAP. Indian using IFRS. International accounting standards are now gradually converting into IFRS. Okay, so coming to the point back, gross profit ratio is the gross profit multiply divide by net sale multiplied by 100%. You are finding the value in percentage, so multiply by 100. And the gross profit is coming from the sales. When you subtract cost of goods sold uh, from sales, so you get gross profit. So we divide gross profit by net sale. Net sale means sales minus sale returns, because when we sell something and the customer, uh, if we have a return policy, the customer return goods, we are supposed to subtract sale return from the sale, and that will be the net sale, and gross profit divided by net sale. Now, comment on this ratio, which is written above. If the gross profit ratio is higher, what will be the consequences? This is gonna be better. The result is better. If you are doing analysis of the financial statement of one company where you want to invest your money, so you have to focus on the gross profit ratio. Here, after analysis, you find that the gross profit ratio is higher. Now, you said that if it is higher, then what? It is better. meaning it shows the relationship between gross profit and sales and the efficiency with which a business produces its product. It will show you the efficiency of a business and the production. Okay, reasons. If high, then what? If low, then what? If high, the gross profit ratio is high. Increase in selling prices, reduction in purchase cost, lower production cost, economies of scale. If low, then decrease in selling prices, increase in purchase cost, higher production cost. And the high ratio is better because we want increasing selling price. If we charge a selling price high, then we would we will have a good margin. Reduction in the purchase cost. If we purchase raw material and the raw material cost is lower, are reduced, then it means that we will sell our goods on good price, reasonable price, which will be more profitable to us. And the lower production cost, when we will purchase at a lower or reduced cost, so ultimately we can understand that we will have a lower production cost, which is better than all. Okay, the second ratio and the profitability ratios are a net profit ratio. So net profit divided by net sale. The net sale is equal to the sales minus sale return, and the net profit is equal to profit after tax. When we pay tax to the government, after the tax, the profit is called net profit. Okay, and the ratio results higher better. It shows the overall profitability of business, show how efficiently the business is conducting its operations to ensure high profitability. Now, reasons for if higher total gross profit, efficient operating expenses, low finance cost. Low, then lower total gross profit, uncontrolled operating expenses, high finance cost. Now, in a comment section, it is if higher, then it is better. Now, higher total gross profit, efficient operating expenses, low finance cost. If the net profit is higher, it means that there are high gross profit. The operating expenses are efficient, and as well as the finance cost is lower. If and only if the net profit ratio is lower, then it means lower gross profit, uncontrolled operating expenses, high finance cost, which is dangerous. Other profit ratios. Similarly, other profit formulas can be formed for operating profits, profit before income tax, interest and tax ratios, and profit before tax ratio as well. Cost ratio. Based on the similar concept, based on sales, cost ratio can also be formed. For example, cost of goods sold divided by sale ratio is equal to cost of goods sold divided by sale multiplied by 100%. So you can make a lot of other ratios. And the third ratio in the profitability ratios, performance ratios are as a return on capital employed. Return on capital employed. Okay. Profit before interest and tax, PBIT, divided by average capital employed multiplied by 100%. What is PBIT? Operating profits is equal to profit before interest after interest of overdraft multiplied by tax. As overdraft is not considered as a debt, for ratio analysis there is interest in is not included in the finance cost for above formula. Capital employed is equal to equity, the fund raised from the general public, plus borrowings, including current portion of non-current liabilities. So this is all equal to, and the command is if it is higher, then it is better. Meaning it is considered the best measures of overall profitability of a business and indicates how well the management has used an investment made by the owners and lenders into the business. It will show the performance of the management where they have used their investment, which has been erased from the owners, the members, and the lenders. For example, banks, other investment entities, they have provided funds which is being managed by the managers in a good way. Reasons: higher ratio, higher profitability, efficient fund management, repayment of loans. If lower, then lower profitability and efficient funds management, new loans, management funds and efficient funds management. New loans. Return on equity is the fourth one. Profit after tax minus preference dividend divided by average equity. Okay, multiply by 100%. Here's preference dividend is on the every redeemable preference shares. We will discuss in another lecture about shares. Now, dividends are the very broader term. You cannot absorb it all if I explain here. Okay, equity is equal to capital and all reserve. That's what. It's simple. Command if higher is better, and measures the overall efficiency of a company. This ratio is of great importance to present and prospective shareholders as well as management. If higher, then low tax rates, higher profitability, higher dividends, reducing equity lower, higher tax rates, lower profitability, lower dividends. And the last but not least, return on assets. Profit before income tax, interest and tax divided by average assets. As assets are total assets, are non-current assets. Okay, uh, meaning it measures the overall efficiency of a company and generating profits using its assets. This ratio shows that the company is using their assets for generating profits. For example, the company is using buildings, uh, plants, and machinery. Okay, and these all things to produce profits, and these are all the non-current assets. If higher, then higher profitability, efficient asset management, lower profitability and efficient asset management. Asset management is also the uh, responsibility of management, and there are all several responsibility of management to perform. Thank you for watching. In the next lecture we would explain liquidity or short-term solvency ratios. Thank you for watching. Thank you very much.